Hello everyone and welcome back to the channel. Today we're going to be talking about Raiz's ethical option, the Emerald portfolio. Just a cautionary note, this is probably going to be a long video, so you might want to get some coffee or something. Let's get into it. The Emerald portfolio has gotten a lot of attention, most notably recently because of its monstrous dividend payout, but prior to that, due to its overall stellar performance. Of all the Raiz portfolios, it's been the best performing since its inception, and this has naturally attracted quite a few people to this option, but I feel a lot of people misunderstand it and where it lies with regards to its place on the risk spectrum. What makes Emerald Emerald? What sets it apart from the rest of the portfolios? Let's take a look at its composition and where it lies on the scale of things. So, from the get-go, it features a 73% breakdown of stocks and a 27% breakdown of bonds and money market funds. This is actually in line with the moderately aggressive, which features the same numerical breakdown, albeit across different ETFs. And contrary to some people's belief, it is actually less aggressive and risky than the aggressive portfolio, which is 90% stocks to 10% bonds. Okay, so we'll have a look at where they share similarities, and like the rest of the portfolios, there's an allocation towards the Australian money market, AAA ETF, and Australia government bonds, IAF. However, unlike the rest of the portfolios, this one has two special niche ETFs, RARI and ETHI. To start things off, RARI, the Russell Investments Australian Responsible Investment ETF, is the Australian component of the portfolio. This is essentially a ESG screened portfolio that's been put together with the basis of trying to get a high yield. Things like tobacco, alcohol, gambling, weapons, and fossil fuels, they're all excluded or very much limited on this particular portfolio. Let's have a quick look at the top 10 holdings here. As you can see, there's the Commonwealth Bank of Australia. That's a bank, obviously. You got CSL, which is biotech. The next three are banks. You've got Telstra. You've got Transurban, which is toll roads, CityLink, that sort of thing. You've got a couple of mining companies, and you've got Insurance Group Australia, which round out sort of the top 10 and give you an idea. Twice a year, a responsible investment committee will meet and review all the options within the portfolio and see if any changes need to be made. Basically, what they do with the selection process is they'll take something like the ASX 200, they will immediately strip the aforementioned holdings out like tobacco and alcohol, and then after that they'll consult with a company called Sustainalytics, which is a company, an outside company that grades holdings on their ESG scores, which is environmental, social, and governance principles. And companies that score highly in those particular subcategories are elevated up the list and the rest are scrapped. And finally, of the remaining companies that make it through that screening process, the companies with the highest dividend yields are normally held. So, which is why we've got a predominance of banks and a couple of mining companies, because that's essentially the bias of the ETF, and that is how RARI invests itself. And this one pays a twice a year dividend, and it has a 0.45% fee on top of what you pay to raise. The ETF fee is taken directly out of the ETF and it's separate from the raise monthly fee. So essentially, this one's a high yield ETF with a bias towards companies with high ESG scores. Alright, let's move along to the next major holding, which is FDE. And this is the international component of the Emerald portfolio. This one invests in around 200 companies overall, up from 100 recently. They did a major restructuring, hence the gigantic dividend that was paid out recently, because they had excess money left over, hence they paid it out to stakeholders. And this particular ETF has a bias towards companies that are climate change leaders and prioritize ethical practices. For companies to make the selection, they have to be in the top 1/3 of their particular sector in terms of carbon efficiency. Things like fossil fuels, live animal exports, junk food, and armaments are all excluded, which gives us the following breakdown. You've got companies like Apple, MasterCard, Nvidia, Visa, Home Depot, Adobe, PayPal, Toyota, Netflix. So looking at that top 10, you can see a very heavy tech bias there. You've obviously got some things like healthcare mixed in there as well. You've got Roche Holdings, United Health, CVS Group, and it is interesting to note that at the moment, this is the only ETF, and by extension portfolio, that Raiz offers that invests in Tesla. So if you're a fan of Elon and Tesla, this might be the one for you. Like RARI, this one pays a twice a year dividend, and this one has an annual fee of 0.59%, which is taken from the ETF itself and separate from your raise fee. So looking at those two, you can see overall that this portfolio is pretty well balanced between Australian shares and international shares compared to the rest. The aggressive portfolio in particular has an extremely heavy Australian bias, which I'm obviously not a fan of, and that's just my opinion. Australia's roughly 1% of the global economy, and we're heavily dependent upon mineral exports to China and selling overpriced houses to each other. So I would rather hedge my bets elsewhere around the world than have all of my, or at least the majority of my money here in Australia. Hence, I personally use the Emerald portfolio that I'm talking about, and I'm quite happy with it overall. It's not perfect. I would probably skew, if I could choose, more towards ETHI and less towards RARI, but that's just my opinion. As far as a preset portfolio goes, it's pretty good, and it's very well suited towards someone with a view towards long-term wealth building and capital appreciation, someone with a time frame of 5 or more years at the least, maybe more. And on this topic of long-term growth, all of you can aid in long-term growth by liking the video and subscribing. It pays the dividend of more content like this in the future. That's all I have to say about this today. My name's Rich. It's been a pleasure, and I will catch you guys in the next one.